Welcome. This is the ATRAM webinar series. We are about to start in a few minutes.
Do you want to make your money work for you but find investment intimidating? Do you want to build towards a better future? With ATRAM Group's funds, you can invest according to your interests and values. Investing is now made easier and affordable. Step into your future self, invest to reach your goals and aspirations. Matching your risk appetite and investment horizon has never been this easy. Let us help you maximize your earning potential by writing the growth story of the Philippine economy and opening your doors to the international trends in the global markets. Let us prepare you for a better financial future. At ATRAM, we're making lives better through investing.
Welcome. This is the ATRAM webinar series. We are about to start in a few minutes.
Lost in a multitude of numbers, graphs, and charts? No time to understand the effect of data such as GDP, inflation, income statements, and cash flow on your investments? Unsure about what's happening to the economy? Don't know the good places to invest? Risk on with equities or risk off with fixed income? Investing nowadays can be overwhelming. There are so many terms to learn and so much data to analyze amidst a sea of investment opportunities. The ATRAM Global Allocation Feeder Fund is designed to do exactly that. The fund is invested in both equities and fixed, combining the best ideas across the full spectrum of asset classes. Investing in equities that offer potential outperformance while using fixed income to protect against the downside, historically delivering more of the upside of global stocks compared to the downside. Flexible and diversified, it seeks the most attractive investment opportunities that give long-term growth while managing volatility. Portfolio managers and analysts will help you navigate across a sea of numbers, graphs, and charts to find you the most attractive investment opportunities, while you can sit back and relax. All this conveniently available whether you invest in Philippine peso or US dollars. Invest in a fund that gives you competitive returns with less risk. Invest in the ATRAM Global Allocation Feeder Fund. For more information, visit www.atram.com.ph.
All right, good afternoon, everyone, and welcome to another exciting episode of the ATRAM webinar series. I'm Stanley Magno, your host from the ATRAM channel management team, and I'm delighted again to have you all here today. Now, in today's interconnected world, the landscape of investing has evolved beyond geographical boundaries. Gone are the days when investors were limited to their local markets. And today, advancements in technology and communication have paved the way for seamless and global access to investment opportunities right from the comfort of your own home. Now, this afternoon, we're here to equip you with the tools, insights, and strategies you need to navigate the global investment landscape with confidence. Whether you're a seasoned investor looking to expand your portfolio or a beginner looking to explore new horizons, our goal is to empower you to make informed decisions and to unlock the full potential of global investing. Now, don't forget to feel free to share your questions with us at any time by clicking on the Q&A button located below your screen and get a chance to win limited ATRAM merchandise. Also, to stay informed about our future events and receive important updates, kindly take a moment to visit our official social media pages by scanning the QR code displayed on your screen. Additionally, a replay of our session will be available on ATRAM's YouTube channel, the ATRAM Studio. You can also access your social media pages by scanning the QR codes provided. You can also check our website at www.atram.com.ph for a more comprehensive information on the market, finance, investments, and all the funds we provide. We'll also be wrapping up with a quick feedback survey after the webinar, so we hope that you can share your thoughts about our session today and how we can further improve our webinar series. Now, with those out of the way, let me briefly introduce our speaker for today, Mr. Shaun Jamieson. Shaun is the Vice President and member of Blackrock's Global Allocation team. As a product strategist, he is responsible for representing the investment team to both retail and institutional clients across the Asia Pacific. Prior to joining the global allocation team, Shaun was a member of the Asia marketing team, focused on content production across the region, as well as acting as the primary liaison for global macro content in Asia. Shaun's service with Blackrock dates back to 2005, where he primarily worked as a product strategist for global emerging markets and based in London after starting as a portfolio manager in implementing trades across the emerging markets equity team in the book of business. Shaun also earned a diploma in journalism from the Auckland University of Technology and holds an investment management certificate. Now, without further ado, let's all give a warm virtual welcome to Shaun Jamieson. Hi,
Thank
Shaun.
you,
How are you
Stanley.
doing today?
I'm great, thank you. I'm great, and thank you very much for that welcome. I feel very flattered, and it's great to see so many people have joined the call. And I'm really looking forward to going through a lot of the things that we're really excited about when we think about global investing and building a diversified portfolio, and in these markets.
Right, Shaun. Without further ado, please take it away. Thank you for being with us today.
No problem at all. So again, thank you very much, everybody who's attended today. What I really want to do is focus, as Stanley pointed out, on exploring global investing and the benefits of having a diversified portfolio. I also want to spend a little bit of time on why we think today's markets provide ideal background for investing beyond borders. And these are not just geographic borders, but also different types of assets and companies. But to start off, I'd like to spend some time on the basics of investing. Now, some of you may be at different points of your financial journey and with different levels of financial knowledge. But regardless of where you stand, it can be helpful to get a refresher every once in a while. There may be some specific details that you've forgotten about over time. If you could just go to the next slide, please. Now, we know investing is important in order to reach our goals later in life. But often when we think about or we ask, how can we actually achieve that? Frequently the response is, well, information about investing is just too difficult to understand. And this is something that I've found personally when I speak with my friends and family. They either don't know where to start, or even when they do get information, they're unsure of how to drill down deep and get the answers that they want. Now, unfortunately, this is just a fact. Investing can often seem confusing, and it does tend to feel overwhelming. The financial industry is full of jargon and acronyms, just like we've got on this slide here. And sometimes it can just be really hard to decipher what's important to pay attention to. And I like to think that understanding these terms is like assembling the pieces of a puzzle. And as we explore some potential solutions over the next 20 minutes or so, let's keep some of those building blocks in mind. So we'll start off with some of the key terms, kicking off with saving versus investing. If you could just turn to the next slide, please. So what makes investing so much different from your normal savings? Why do we see these as two distinct things to do with your money? Well, both of these activities serve distinct purposes, and understanding their differences is essential for effective money management. So for savings, it's more of a short-term focus. Savings are like the reliable everyday staple in your pantry, like the rice that we have here. You set your money aside for immediate needs and unexpected expenses. Treat it as a bit of a safety net. Now, there's minimal effort involved in saving. You could simply deposit your money into a savings account and just let it sit there. No complex strategies or active management needed. And what are we saving for? Well, they're ideal, as I say, for covering everyday living expenses, building up an emergency fund, or even for saving up for short-term goals like a vacation or a new phone. But on the other hand, we've got investing, and that is almost the exact opposite. We're looking at a long-term perspective, and we look at it as, I think of it more as, adding a little bit of flavor to your meal. So as we've done here, takes a little bit more effort and time, but the potential rewards are substantial. So consider it like cooking up a delicious adobo. That does, however, require investing. Investing does also require understanding different asset classes and stocks and bonds and real estate, assessing risk and making informed decisions. It's more effort, it's more research. It's not a passive process. And also investing is geared towards your long-term goals. And these could be 20, 30, 40 years in the future. If you're thinking about financial independence or retirement, or leaving a legacy for your children, investing becomes crucial. These goals require more than what a savings account can offer. If you go to slide 4, please. Now, what's really on everybody's lips been the past couple of years? It's been inflation, the silent, persisting force that's gradually eroding the purchasing power of our money over time. So let's dive deeper into this phenomenon and explore how investing can be our ally in the battle against inflation. So short-term inflation is indeed noticeable. We've all seen it. Prices rise and our wallets feel the pinch. But it's the long-term impact that truly matters. Over decades, even seemingly small inflation rates can significantly diminish the value of our hard-earned money. So we've got an example here with the movie ticket. So the experience of going to the movies remains very much the same. You go in, you get your snacks, you settle down, you watch your movie. Yet between 1950 and 2020 in the United States, the average ticket price ballooned from a mere 46 cents to $9.16. That's quite the leap. So imagine we jump back into our time machine with a $20 bill right now into 1950. Now we could have purchased 43 movie tickets for Cinderella. So you could have brought along all your family, many of your neighbors to go and see Cinderella in 1950. However, in 2020, if you wanted to go and see Endgame, well, that same $20 would barely cover tickets for you and a date. Inflation has really nibbled away at that value of the $20. So this is where you could use investing as a shield. So investing isn't just about chasing wealth, it's also a strategic defense against inflation. So we could grow our money. When we invest, our money has the potential to grow faster than inflation. Whether it's stocks or bonds, real estate or other assets, they aim to outpace rising prices. And the gap matters. The wider the gap between our investment returns and the inflation rate, the less impact inflation has on our overall wealth. So investing really is like planting seeds for the future, goals that span decades. As I mentioned, things like financial independence or retirement or building a legacy require more than a savings account can offer. To do that, you need to invest wisely. So you need to stay informed, understand market trends, economic indicators, and inflation rates. Remember your time horizon. Investing is a marathon, not a sprint. Continue to think long term. But most importantly, and what I'm going to spend a lot of time on in the next part of the session, is diversification. Spread your investments across different asset classes in order to mitigate risk. If we just move to the next slide, please. So to take advantage of all the market offers, you need to ensure you are getting adequate risk-appropriate diversification. Put simply, the key is in creating a diverse portfolio. You may have heard this term diverse portfolio before, and we are going to dive deeper into it, but let's just break it down really quickly. The portfolio, well, that's just the collection of assets, like stocks and bonds within your investment account. Diverse refers to that collection consisting of different assets, so not all stocks, not all bonds, or all one investment type of each, or all of something else. Risk and return are directly correlated, and with higher potential to grow, there's also a higher potential to lose as well. Don't forget that every asset has its own unique risk and return profile. So diversification can also act as a shield against risk, by which I mean the likelihood of losing your money. By spreading your investments across different assets, you reduce the impact of any single asset's poor performance. Correlation. Now, assets don't always move in sync. When stocks go up, bonds might go down, and vice versa. Diversification capitalizes on these differences. And you need to figure out the balancing act between stocks and bonds. Stocks offer high potential returns, but come with extra volatility. Bonds are more stable, but they yield lower returns. Balancing both minimizes extremes. But it's important to remember, diversification isn't about avoiding risk altogether, it's about managing risk wisely. If you just go to the next slide, please. So over the next few slides, I'll be speaking to you about why you want to build up diversification in your portfolio and some of the ways in which you can achieve that. Move to the next slide, please. Now, as current interest rates have risen, cash has become very attractive for risk-averse savers. money market funds have been yielding returns close to 5% in 2023, with minimal risk involved. However, this conservative approach has its trade-offs, as we can see in this graph here. The remarkable surge in equity markets last year favored those who invested, as equities saw exceptional gains. Similarly, fixed income investments ranging from Asian bonds to high yield have all delivered returns that surpass that of cash holdings. So the opportunity cost is tremendous, and in fact, those investors who have been focused solely on cash have been missing out on the opportunities that other parts of the market have provided. If you could move to the next slide, please. And for those investors who want to be more than just savers, there is a risk in holding on to cash too long and not starting to participate in the markets ahead of time. Historically, money market returns have fallen steeply once we come off peak rates, a point in time that we are getting closer to, as the expectations are that the US Federal Reserve will cut rates in the latter half of this year. Now, as you can see in those graphs there, at both these times, we've seen the cash coming off. 2001, cash returned an annualized 2.3%. In 2007, cash returned an annualized 2.2%. But one of the important things also to notice here is the performance of fixed income at the same time. So as cash was falling, the fixed income returns were climbing and outperforming cash. So being able to be in that diversified portfolio during those periods of time are very important. We move to slide 9. Now the question comes to, when would be the best time to invest? Well, if history is any guide, this is the best time to consider what some call escaping the cash trap. Now, if we look at the past 5 Fed cycles since 1990, bonds have produced average annualized returns of 14.8% during the period between the last Fed rate hike and the first rate cut, what we're calling here the rate pause period, versus just 5% for cash. Equities have also shown robust performance, surpassing both cash and bonds during those hold periods. So investing during the pause in this interest rate adjustment has historically yielded better results than the easing cycle. Now, this counters a common belief that rate cuts are the catalyst for sustained rallies in bonds and equities. The data indicates that the hold period presents a strategic opportunity to move away from the so-called cash trap and capitalize on the potential gains from bonds and stocks. We move on to slide 10, please. Now, some investors prefer to stay solely within their own markets, but there is probably only one equity market in the world with the built-in diversification to support that strategy, and that's the United States. Now, what we've done here is we're comparing global stocks as represented by the MSCI All World Index to the MSCI Philippines Index. And you can easily see here that investors who stick to the Philippines are disadvantaged by that lack of sector diversification when compared to global stocks. Now, we're looking to see, the MSCI Philippines, and where are we missing out? It features no information technology names, no healthcare names. Now, it also has very large exposures to the financials, industrials, and real estate sectors. Now, this is what we would call concentration risk, meaning if something goes wrong in one of these areas, say a collapse in office rental prices in the Philippines or issues in the local banking system, that could cause a significant drag on returns. The lack of diversification also means that those who exclusively invest within the Philippine stock market may find it harder to benefit from some of the long-term trends, such as AI in the information technology space, or say the increasing demand for medical technology and services due to an aging population in the West that the healthcare sector speaks to. If we move to the next slide, please. Now, here to further illustrate the impact of incorporating global stocks into a portfolio that's currently exposed only to the Philippines, we can examine how this diversification affects both the returns and the risk levels of your portfolio. So the chart we're looking at here presents the 3-year return of the PComp index with the addition of varying levels of exposure to global stocks. And the data clearly demonstrates that, that diversification not only leads to a significant increase in your returns, but also contributes to a reduction in the volatility of your portfolio, thereby lowering your overall investment risk. This strategic approach to portfolio management underscores the benefits of global diversification, as it allows you as investors to tap into a broader range of sectors and trends, potentially enhancing returns while mitigating risk. And I think this is a compelling argument for moving beyond a singular market focus and embracing a more global perspective when you're making your investment decisions. We move on to the next slide, please. Now, some people are willing to accept a high likelihood of modest returns for the slim possibility of achieving substantial gains. This is a phenomenon that's often referred to as the lottery effect. And this mindset also explains why some investors might concentrate their investments in individual stocks or pull their resources into the latest trending startup or investment craze. So the allure of potentially large returns can sometimes cloud judgment, leading to decisions that may not align with the best chances of investment success. So this practice, which we're known as stock picking, we can see here, as the data indicates, can be a challenging strategy to execute successfully at the level of individual stocks. From 2019 to 2023, there was a nearly 40% chance that any given stock an investor would choose would have resulted in a loss. Now, contrast that with investing in a diversified portfolio through vehicles such as a mutual fund, and this proved to be much safer, with less than 1%, only 0.1% of such funds experiencing losses over the same time span. This stark contrast highlights the risks associated with stock picking and underscores the benefits of diversification in mitigating investment risk and improving the likelihood of positive returns. If we move to the next slide, please. And I recognize there's a lot going on in this slide and it's very colorful, so I'll try and talk you through it as clearly as I can. Diversification is, as we've talked about, a fundamental principle in investment strategy. Now, the inverse relationship between stocks and bonds is an important one to notice. Different assets often move in different directions. As we say here, some zig while others zag. And that's because every asset class, as I think I mentioned earlier, has their own unique risk and return profile. But even within these asset classes, there can be a great dispersion of returns on a year-to-year, month-to-month, or even week-to-week basis. Return rankings change dramatically. And while diversification cannot eliminate the risks of investing, being aware of this illustrates why investing across a variety of assets can help. So let's take the example in here, and we take a look at let's take a look at Chinese equities, which in 2020 returned almost 30%, leading the pack in this chart over here. Now, if you were solely invested in Chinese equities, 2020 was a great year for you, and you might be tempted to stay in that asset class going forward. But as we can see in 2020 and 2021 and in following years, Chinese equities saw a dramatic reversal, underperforming and wiping out any gains you may have received from their strong 2020 performance. And throughout that table, you can see similar trends across all asset classes, reinforcing just how challenging it can be to count on consistent returns when you focus on a single asset class. So by combining assets with that different risk and return profile within a single portfolio, investors can leverage the counter movements of these assets to balance the overall risk. Now, this strategy aims to stabilize the portfolio by offsetting the risks associated with individual asset classes and ultimately looking to reduce the total risk and create a more resilient investment portfolio. Our overarching goal is to achieve a smoother investment journey for investors with the potential for consistent returns over time. If we move to the next slide, please. Now, as I've talked through, and as you may have picked up from here, these are a lot of variables, and managing all of these variables is immensely challenging for a single investor. And that's why the Blackrock Global Allocation team, we are a group of more than 50 experts who make up the team. We're led by Rick Reeder, who's Blackrock's CIO of fixed income, and he manages over $3 trillion of AUM. And we have an analyst team who are split between doing macroeconomic research, i.e. looking at what's going on within the markets as a whole, fundamental analysis, and looking at companies, researching different sectors, etc., and quantitative strategies, which look at how do we implement those investment ideas and put them into our strategies. Now, around 2/3 of our investment professionals are these fundamental analysts doing bottom-up research. And these are organized primarily through sectors and industries. And this means that every position that we think about putting into any of our strategies is thoroughly researched. It's been hand selected. And then with the work of our quantitative strategies team, it's optimized to ensure that we are gaining the correct exposure to companies, countries, and sectors that we like by being in the right asset class, by being of the right size, and being aware of the risk that each position brings to the strategy as a whole. And how does that play out in our strategies? If we just move to the next slide. So you can see here, there's an enormous level of flexibility and the ability to move quickly to adapt to shifts in the market environment is key to be able to deliver strategic performance. Now, we adopt what we call an unconstrained approach. So in practice, this means our investment management team have the ability to find attractive investment opportunities globally and across asset classes, benefiting from all of those aspects of diversification that I spoke about earlier. Now, on the right-hand side of this chart, you'll see a list of the type of asset classes that we invest in and the type of diversification that can be achieved in just one strategy. Now, another hurdle to achieving this level of flexibility and diversification for individual investors is gaining access to markets. This is something you don't have to worry about when you're looking at a broader diversified strategy. Now, many markets require a long and complicated account opening procedure, for example. Access to bonds for an individual investor can be challenging depending on how much you have to invest or what type of bonds you're looking for. So looking at a strategy which has all of this built in, has this unconstrained exposure, is obviously very helpful. So I'd like to finish off now with just a couple of key investment disciplines that we believe you should be thinking about when you think about what you should be doing with your hard-earned money. And also, one of the key questions that I've been getting when I've been speaking to clients over the past month or so around the US elections. So I'll talk a little around that. But if we just move on to the next slide. So, as it turns out, limiting losses, especially big losses, is the true key to investing success. Now, Warren Buffett has said the first rule of investing is not to lose money, and that rule number 2 is not to forget rule number 1. It's all about math. When you start off with $1 and you lose half, you're left with 50 cents. So, what do you need to be up to break even? Well, you need to double it. You need to be up 100% to get back to break even. But if you go down 10%, well, if a loss of 10% requires an 11% gain to recover, that's quite manageable. But this goes to show that it's not a linear progression like many think. In fact, as losses grow larger, the size of the return needed to recover increases at an even faster pace. So if you look at that 50% loss with 100% gain to recover, you then look at a 60% loss, you need a 150% gain to recover just to get to break even. Now, with individual securities, it's very possible to see these large drops in value, but it's much less likely in a diversified portfolio. And this is the thing, if you want to go in there, if you've got a diversified portfolio with a large amount of holdings, it's very unlikely that any one specific holding would be able to make or break your portfolio. All of these holdings work together. And then my final slide would be next. Now, as I mentioned, this is a topic that has come up a number of times on conversations that I've been having with clients recently. And generally, it's who do you think is better for the stock market, Biden or Trump? Well, as this graph answers, shows the best answer is probably either of them. If we look since 1926, admittedly a long time ago, and this was amid repeated shifts of the political landscape, the S&P 500 has produced cumulative returns of almost 1.5 million%. And this really reinforces the importance of staying investing over the longer term. But if you can break that down, even within the Republican or the Democrat time as president, over virtually all of these time periods, the stock market ended up. The only time period where we had probably coming out of a lower stock market was George W. Bush, obviously when we were coming out of the great financial crisis. But the longer term investment stays the same. Now, if that long-term performance isn't enough to tell the story, the returns of stocks during a presidential election year also tells a great story. On average, stocks have risen 11.6% during presidential election years since 1926. This is slightly better than the market's average 10.3% return across all years. And if you drill down further, stocks tend to follow a pattern during presidential election years of being sluggish in the first half, followed by a big second half. Historically, the third quarter has delivered the strongest returns, with an average return of 6.2% for the quarter. Now, look, there's no guarantee that the market will follow this pattern in 2024. And of course, elections have consequences for fiscal policy, which can affect financial markets. But we think the combination of the Fed's expected pivot to rate cuts and the US economy's continued positive momentum are compelling reasons for investors to move out of some of the large cash positions they've been sitting in. And this should be supportive for US equities and beyond for the rest of the year. And if we just move to the next slide. So just in summary here, just a few things that I just want to just end with. Broadening your scope, as I mentioned, looking at where you can diversify out of cash, looking at where you can diversify out of local investments, single company stocks and bonds, single asset classes. The broader you can get your portfolio, the broader you can get that diversification, the better it is for your risk return profile in the long run. Leverage global investment experts. There is a wealth of information out there, and as a individual investor, you may not necessarily be able to get immediate access to it, but you have phenomenal partners here with ATRAM. Leverage the knowledge that they have. And of course, the key thing is stay invested for the long term. I think, as I mentioned earlier on in this presentation, investing is a marathon, it's not a sprint. And as we've seen through some of the charts that I've shown you today, including that very last one around the US elections, if you stay invested for that longer term, the amount of returns that you could get from that is astounding. So on that note, I will finish with this part of the presentation, and I will turn it back to Stanley.
All right, Shaun, thank you so much for your valuable insights and expertise this afternoon. It was a great contribution to today's webinar and undoubtedly enriched our understanding of global investing. Through a great host of key points. You started with the foundations of investing. That was great. And we really went global. And for our dear audience today, a few key points on going past individual company bonds or stocks. And at the core of it, really, diversification and how that's beneficial to everyone. As we're wrapping up today's webinar, I wanted to leave everyone today with a compelling opportunity to navigate the complexities of global investing and investing with confidence and less risk, right? I think a lot of people today are asking, how can we take advantage of this diversification that Shaun just talked about, right? Wanted to quickly introduce the ATRAM Global Allocation Feeder Fund. And this is managed by Shaun's team, Shaun's excellent team at Blackrock. He had a slide talking about their team today. So for many Filipinos, global investing, I think, can seem a little daunting, right? Especially when faced with challenges of understanding the vast global markets while minimizing risk. And that's where the ATRAM Global Allocation Feeder Fund comes in. So this fund offers a comprehensive solution, investing across the full spectrum of global assets while prioritizing risk management. And by leveraging BlackRock's flagship multi-asset fund, the Global Allocation Fund, this is the one Shaun just discussed, we're able to tap into the growth potential of the global economy with 1/3 less risk than funds that are a little more volatile, right? The average allocation is 60% to equities and 40% to fixed income. We'll talk about this later. And the fund is tailored for investors seeking growth potential while mitigating the short to medium term risk with the fixed income part. And whether you're in your 40s looking for something to optimize growth, or you're a younger investor looking to diversify, or even older investors looking for a bit of stability, I think this fund offers a more personalized approach to your global portfolio management. So, dear audience, don't let uncertainty hold you back. If you're taking that first step towards global investing, let's let the ATRAM Global Allocation Feeder Fund guide you. So, again, this fund is managed by the amazing team at Blackrock, mentioned by Shaun. So, let's let this fund hold your hand as you navigate through these global markets. And reach out to our team today to learn more about how to embark on your global investment journey with confidence. I'm sure everyone here is excited about the question and answer segment. I'm seeing a lot of activity in our Q&A section. Guys, please feel free to add more questions. But let me share with you some outstanding recognitions ATRAM has received in 2024 that we're proud to share. We have happy to showcase our commitment to excellence and innovation. We've been awarded the Best Asset Management Company in the Philippines for 2024 and the leading asset management company in the Philippines for 2024, highlighting our top-tier services and global standing. And we are proud to be recognized as the most innovative fund management firm for the Philippines and the leading innovative asset management company, demonstrating our dedication to these cutting-edge solutions. Furthermore, we've also been named the leading asset and wealth management manager in the Philippines for 2024 and Asset Manager of the Year for the Philippines, reaffirming our position as industry leaders. Now, we owe this dedicated success to our team, pushing boundaries in the investment industry. And our heartfelt thanks goes to our clients and partners for their unwavering support. Rest assured, we remain committed to excellence and innovation as we redefine the asset and fund management space. Thank you, dear audience, for being a part of our success story. Now, for a portion I think everyone's very excited for, we're opening the floor for our live Q&A session. Please feel free to send in your questions in the chat box and our speaker will be happy to address them. Now let's open this up. The first question I'm looking at here is for Shaun. Okay, Shaun, one question coming in from the audience. Shaun, you mentioned that the Philippines is concentrated on certain sectors. I think this goes the same for a lot of local markets. What themes or sectors are Filipinos missing out on if they don't invest globally? I think this was mentioned also earlier.
Yeah, thanks. Thanks for the question, Stanley. So yeah, I mean, I did mention earlier, I can I can dig a little bit deeper into that. I think the key ones, and certainly the ones that we look at when we're building our portfolios at the moment, are the information technology sector and the healthcare sector, which are areas that we like and have liked for quite a long time within the global allocation strategy. These are part of what we are calling our mega trends. And we look at not only how is AI, for example, impacting information technology directly, but how is AI going to be impacting a number of other companies, and what is the connection between these and other sectors, and how they play out. So not having that exposure, certainly at this juncture, to that AI story, I think could be detrimental, given where AI is traveling through. And healthcare it's a long-term story. It's something that, as I say, we have been looking at for a very long time, and it's one that's going to go on for demographics aren't going to change. We see in the United States, we see in Europe, we see in Japan, we're now starting to see in China. This aging population who are going to be looking for healthcare services, who are going to be looking for medical devices, new medical devices. And in fact, one of the areas that we're getting very excited about at the moment is that intersection of healthcare and AI. Things like the usage of robotics in surgeries and things like that. Now, these are obviously themes that can't be explored through just investing within the Philippines. These are ones that definitely we need to look at a broad, more diversified portfolio. We're able to pick stocks up from the United States or from Japan or from the Netherlands or across the globe, basically, in order to really benefit from those themes.
Thanks, Shaun. I think through the global allocation strategy, we're able to tap into a lot of these exciting factors trading and information technology, healthcare, and even the exciting things within those intersections. All right. Looking at a few more questions coming in. This one's for you again, Shaun. Are there any specific tools or resources you would recommend for someone looking to research global investment opportunities?
Oh, there are so many. It's almost difficult to know where to start. I mean, obviously, the internet is a fantastic resource in terms of learning about the key drivers that are happening in all the various different markets. I think it's very important for investors to ensure that the funds or the products that they're looking to invest in align with the current trends in the global market. But this is where obviously the great relationships that you have with your investors come into play, and certainly speak to, you can talk through what's going on within those portfolios and explain, where are those views. But yeah, I mean, like I say, from a resource perspective, I could spend just an entire day online finding bits and pieces coming from various different sites, and just making sure that you're up to date on the news, on those news flows, and then you can look at what's coming through and saying, oh, okay, now I understand why this portfolio is overweight Japan, for example, or why I understand why it's avoiding some other sector, for example.
Perfect, Shaun. Thanks for that. I'm sure you and your team spend a lot of time doing so as well. And it's great advice also to clients to understand what they're investing in as well. This next question comes in and it's directed towards me. How does the ATRAM Global Allocation Feeder Fund compare to other global investment options available in the market? So thanks to the audience for sending this one in. So if we're comparing the ATRAM Global Allocation Feeder Fund to other options available in the market, right? Maybe we can look at it in a few ways. I think, and as discussed earlier, it uses a 60-40 equities fixed income split, right? So this is a pretty traditional, or sort of what they call a gold standard split of allocation. Traditionally, and I mean, it's a long-standing approach, academically backed investment approach, both for beginners and experts, right? You don't, and as Shaun mentioned earlier, you don't want all your eggs in one basket. It's good to have both a mix of stocks and bonds. So 60-40 has been sort of tried and tested across a long span of time. So in the local market, actually, here in the Philippines, it's the only fund that can actually give you this sort of golden ratio or good balance. So it's unique in that space versus other global investment options. I think that's one, versus other options here in the Philippines. And interesting to note, I think here in the Philippines space, when they talk about global investing, a lot of financial YouTubers would talk about, just invest in the S&P 500. Maybe for the audience, I mean, that's one way to go about it, but the S&P 500, a lot of people talk about it. It's pretty top or tech heavy right now, right? But some would consider it a little volatile. What does that mean? It's prone to some pretty strong swings just by the nature of it being composed by the Mag 7 or a lot of these tech companies right now. So by the nature of the global allocation fund currently, as Shaun also mentioned and we discussed earlier, a lot of it is in fixed income. You have a little more protection from the downswings right now, right? And I think on the third point, versus other global options, you have true global diversification, right? You're not just purely on the S&P 500, but globally as well. So other global investment options, I think that's one way you can look at it. Thanks to the audience for sending these in. And again, feel free to send in more questions. Looking at other questions in here, this next one's for you, Shaun. As someone who prefers a more conservative approach to investing, how can I still participate in global markets without taking on too much risk?
Diversification. Diversification is the key. It is very easy, and I think just as you've mentioned, going into the S&P 500, is that even diversified enough? Probably not. We definitely want to ensure that any strategy that we put together has that diversification of not just sector, but also country. So those risks are balanced. and looking at how do you moderate that risk while providing a strong level of return. The more diversified the portfolio is, the better it is for somebody who doesn't want to take on very high levels of risk. If you want to take a slightly more conservative approach, that would be the number one thing that I'd be looking for, is ensuring that that portfolio has that level of diversification within it.
Perfect, Shaun. Thank you about that. The next question is actually, pretty related to risk. Also, directed for you, Shaun. Do you think markets will go up once the Fed starts reducing rates? I guess it's a question a lot of people have. We wanted to get your take here.
I think that's obviously, that is likely to, yes, that is likely to happen. But I think, as I pointed out in the presentation earlier, that historically, it's actually been during this pause period. So being involved within getting into the market right now between the last rate hike and the cut is actually the best time for stocks and bonds to perform, rather than I think stocks will go up, but I think the question is, on what side of the Fed rate cut do you want to be? Do you want to be in there and buy it at a lower level and then it goes up? Or do you want to wait until the cut has been made and you may miss out on some of that upside? But I certainly think, and this is something that we talked about, when we weren't sure when rate cuts were. One of the more interesting things I find is that corporates, what they really don't like is uncertainty. And we found that a lot with some investors as well. They don't like uncertainty. So while things are, we don't like it when it's going up, but when it's at this plateaued level, when we're at this rate pause level, companies can deal with that. They know what they're paying. They know what interest rates are likely to be. So I think I wouldn't put it this way. I think waiting until stocks go up until the rate cuts happen, that is definitely an approach to take. But I definitely think it's worth looking at what's happening within markets right now.
Perfect. Thank you so much, Shaun. The next few questions, we have one, and I guess this is good for opportunities for investing right now. I'm new to global investing. How do I get started? And what are some key considerations I should keep in mind?
Again, I think it's if you're new to global investing, I definitely think being prepared, knowing what you're investing in, knowing what you are, what that structure is, what the structure of the portfolio is, looking at where you can have that diversification in the asset class, in the country, in the sectors that are within there. Global investing to me would not be swapping one market for another. I don't necessarily think it's going, oh well, I won't invest solely in the Philippines. I will just invest in the United States, or I will just invest in Australia, for example. It is, global investing just opens you up to such a wide range of opportunity and potential. But I do think it's obviously very important to know what is going on within that portfolio that you're looking at investing in. So my advice would be to, do a lot of research before making that decision. But if you're new to global investing, make sure you feel comfortable in what is being sold. Make sure that it's an appropriate risk and return level for you. But the opportunities, as I say, for those who are in global investing, it's fantastic.
Perfect. Thanks, Shaun. And as you mentioned earlier, there are lots of resources out there that people can use to stay informed, right? The last question directed at you, Shaun, is here. Good afternoon, sir. Besides AI, what are the future trends in global investing? Healthcare, longevity, space-based economy, etc.
Sure, healthcare definitely one. Another area that we've been focusing on and looking forward to is what we call reshoring One of the big, and this is particularly impactful for China, one of the big knock-on effects from both COVID and the increased geopolitical tensions between the United States and China has been many American companies have been looking to bring back their supply chains from China, and we're looking at seeing that going into places like India, like Vietnam, like Mexico, and there's a lot that comes from that in terms of as a thematic. We're also looking at the difference between within the consumer space, the difference between goods and service demand. I think, if we're looking at inflation levels, goods inflation is falling off, services inflation is picking up, which makes sense if things are ultimately costing you less over time. You've got more money to spend on to spend on services. So we're looking at where's the way that we can invest that talks to that theme. So those are some of the key areas that we're looking at as well. And each of these themes, AI, healthcare, reshoring, and consumer, have a number of sub themes sitting within it, and there are different ways to play it. And there's certainly things that we look at for perhaps a shorter or more tactical view over time, and obviously some longer term things as well.
All right, Shaun, thanks for giving us your broad view of the trends for global investing. So we're down to our last question, and after this, we'll do a quick wrap up. It's directed to me. How do we invest in the ATRAM Global Allocation Feeder Fund? Thanks for sending this in. This fund is currently available on the Maya Funds platform and on our very own ATRAM Prime platform. The minimums here are at 1,000 pesos, as we try to make investing as accessible as possible so you can cost average and invest regularly and make it a habit. And I think that's all the time we have for questions today, this afternoon. Before we end this question and answer, Shaun, would you have any final thoughts and insights that you'd like to share with our audience?
So, well, obviously, first of all, thank you once again for letting me speak to you today. It's been a real pleasure. Look, I would like to say, I think we're at a really exciting point in the year. We think there is a lot of potential out there within the market, within global markets, to look at where we're investing, how to get involved across this beyond borders, moving into various different areas, various different countries, various different asset classes, various different sectors. This potential is outstanding. And I think looking at that now, this could be the time to consider making that move into broadening out your views and working with your partners at ATRAM to look at how do we build further.
Shaun, thank you again for your time and your expertise, and we look forward to future opportunities to learn from you again. All right.
Thank you so much.
And now for a comprehensive overview. For all the funds that we provide, we invite you to explore our website at www.atram.com.ph. Feel free to visit for more detailed information. And did we mention that for as low as 1,000 pesos, you can already jumpstart your investment journey? Here's how you can invest in ATRAM funds.
Good day. If you are interested in investing with ATRAM, the leading independent asset and wealth management company in the Philippines, please visit our website, www.atram.com.ph. We have all the details you would need to know about our funds. If you would like to start investing, click Invest Now. For further assistance and account opening, you may email our client services team. If you have more questions, visit the website's frequently asked questions page or ATRAM Academy page. We hope this helps. Thank you.
Apart from that, we also have ATRAM Prime. ATRAM Prime offers access to a diverse array of investment options. These options empower you to tailor your portfolio according to your specific goals and risk tolerance. Committed to long-term growth, ATRAM Prime's expert fund managers utilize proven investment strategies, guiding you towards the creation of enduring wealth. And once again, kindly take a moment to visit and scan the QR code on your screen to access our official social media pages. You can catch a replay of today's session on ATRAM's YouTube channel, ATRAM Studio. You can also check out our website at www.atram.com.ph for more comprehensive information on the market, finance, investments, and all the funds we provide. Lastly, we would greatly appreciate it if you could participate in the survey at the end of this webinar. Your thoughts on today's topic are important to us. On behalf of ATRAM, thank you for attending today's session. We extend our best wishes and continued health and safety to you and your loved ones. A wonderful day, everyone.